Hi, everybody. Welcome to our DAT IQ weekly market update. This is our update for June 10, episode 342. I'm Dean Croak, market analyst here at DAT, along with special guest today, Chris Henry from KSM Advisors. Welcome, Chris.
Well, yeah, thanks for having me, Dean. Glad to be back again. I think this is my third time.
Yeah, it's always good to have you back on. Chris, I was talking to a friend of mine who runs steel out of Hamilton across into the Ohio River Valley. He showed me a video of the 401, which was pretty much empty. He said in his 30 years, he's never seen anything like this, where truckload volume that's cross-border is almost negligible. The 401, as you and I both know, is normally wall-to-wall with trucks 24/7, but not at the moment. What sort of things are you hearing north of the border in Canada?
Yeah, so the cross-border activity has definitely dropped off. I'm a frequent user of all the ports of entry by car, Blue Water, Ambassador, the tunnel in Detroit. And right after the quote-unquote Liberation Day, you saw a huge ramp up in traffic, so 4 or 5 hour delays.
Right.
Some of that was increased inspections going both ways, but I've seen it firsthand that the traffic is definitely down. And then talking to Canadian carriers that I'm friends with, especially the steel haulers, the flatbedders, they're definitely seeing the effects of the increased tariffs, both on aluminum and steel.
Yeah.
So that's real. It's having a tangible effect. And I think the traffic going north of the border, north from the U.S. is down due to there's a lot of Canadians boycotting purchasing U.S. goods because of this trade war. So
yeah. When I crossed over into Canada a few weeks ago, I was struck by the amount of police, customs, border patrol presence when you cross over the bridge into Canada. I was struck by the fact they were pulling up every single truck, but not just coming into Canada, but going into the US. So MTO. I think it was the MTO was the main authority there. They were pulling over everybody, Chris, and this has been going on since January.
Mm-hmm. Yeah, and an interesting fact is I have a visa that allows me to work within the United States, so I cross very frequently. And up until February, I would get maybe one question from Canadian Border Services coming back. And now I get more questions from Canada agents versus the U.S. agents. So you'd think it would be the opposite based on what's being put out there in the media. So
yeah, well, I was up there to get my Nexus card. So and I've got a bunch of truck shows to go to. So I can't wait to roll across there in my truck with my Nexus card and see how I go.
Awesome.
Yeah. Well, so Chris, for those that don't know you, tell us a little bit about what you do at KSM.
Yeah, so KSM Transport Advisors is a division of KSM Business Services, which is a large accounting, tax, and audit practice based in Indianapolis. We're about 900 employees. KSM Transport Advisors, though, is a small, hyper-focused consulting practice. And what we do is we do two things for our carriers, which are almost entirely OTR truckload carriers. And that is help them better understand the profitability of their network. So looking at it from a macro basis as well as a micro. So on a load by load basis, what loads are generating profits, which lanes, which areas are generating profits, and which ones are, stealing profits from your network, and creating action items and plans to improve on that. And then the second part of that is something we recently introduced called Freight Marks. And that allows these carrier clients to benchmark their performance on all of our 150 plus measurements versus other similar carriers. So van, reefer, flat, different lengths of haul, etc.
Got it. All right, let's dive into that a little bit later on. I'll quickly get through the market update, and then we'll bring you back in, Chris, to dive into some of the trends you're seeing. All right, let's start off spot rates. Capacity remains fairly loose in the dry van and reefer market. Flatbed is, of course, starting its slow seasonal decline, which will extend through August in terms of spot rate movement. Produce season, a little bit concerning. California produce volumes down about 28%, excluding citrus. So these numbers will change once we get June citrus reporting in. But we had a colder spring late start. USDA reported a surplus of trucks last week in the California Central Valley. That's something you rarely see in the 4-week lead up to July 4. So compared to last year, truckload volumes out of California are about 2,500 fewer. So we're seeing lower rates out of California for fruit and veg in particular. It's about 14 cents a mile lower. USDA reports truck availability is at a 2 on a scale of 1 to 5, 5 being very tight, 1 being very loose. 2 is a surplus of trucks. Normally, California starts June at a 3, which is sort of adequate. ISM came out last week. It dipped to 48.5, manufacturing second or third, actually, straight month of contraction. New orders fell for the fourth month, though. That's the more concerning sub-index that we're watching. The LMI came out. Zach Rogers reported some mixed signals, contrasting the noticeable slowdown in inventory movements last year and increasing costs made up the mixed signals he was reporting. Class 8 trucks, according to ACT Research, down 44% year over year. Kenny Veith at ACT Research expects continued trade uncertainty will slow order activity as we enter the weakest seasonal periods in terms of orders. Kenny doesn't think any improvement will reveal itself in new orders until the opening of the 2026 order boards in Q3 of this year. And of course, this week marks the 1 month time frame away from July 9, where the end of the 90-day pause on US reciprocal tariffs ends, except China. So we're expecting a surge of import volume up until then. Don't forget the long form version of today's market update will be out this evening at dat.com/market update. So let's start with our load to truck ratio. Post Memorial Day, dry van load postings up slightly, up about 3%, matching last year's numbers, only about 1% behind last year's. Truck postings back to normal, load to truck ratio down to 5.46. In the refrigerated market, load postings fell 4% last week, reflecting the softer produce season. Volume still up about 1% year over year. Load to truck ratio down to 9.10, down 5%. And in flatbed, load post volumes were up last week after the shorter Memorial Day holiday week. Carrier posts up about 30% as those carriers came back into the market. The result in the load to truck ratio was it dropped about 11%, landing at about 25.91 loads per truck. Having a look at our year-over-year look at spot rates, these are excluding fuel, so these are line haul only. Dry van line haul spot rates were flat last week at $1.69. That's 4 cents a mile higher than the same time last year. Also, identical to where it was in 2023, as you can see on the chart with the correlation to the black line there. Top 50 lanes, based on the volume of loads moved, ended last week at $2.02. That's 2 cents a mile higher than the previous week and about 33 cents a mile higher than the 7-day. In our 13 key Midwest state, they represent about 45% of the national load volume. They're generally indicative of national trends in the Midwest bellwether states. They were up a penny per mile last week. This increase occurred alongside a 36% surge in outbound load volume. And again, we had a short work week the period prior. So, but again, those rates in the Midwest states are about 21 cents a mile higher than the national average. Carriers were paid about $1.90 last week in the Midwest. In the refrigerated market, rates still held steady last week at $1.97. They'd been declining for the 2-week prior. And of course, that's impacted by the produce season. The rate matches last year's, but falls about 12 cents a mile short of where it was in 2023. Normally in this 4-week lead up to Independence Day, we see a surge in produce volumes. This year starting off 19% behind nationally. California figures are lagging, as I reported earlier. Surplus of trucks, not looking good from a rate perspective. Looking back in 2024, produce volumes jumped 22% in the 4-week period beginning this week. Rates were up about 8 cents per mile. Therefore, there's still potential for rates to increase due to produce seasonality in the next 4 weeks. However, this appears to be more of a modest increase rather than a significant spike that we'd see in strong produce seasons. In the flatbed market, the average flatbed spot rate last week, not including fuel, was down a penny per mile, averaged $2.18. That's about 12 cents a mile higher than where it was last year. All right, having a look at our short-term forecasts. This is our forecast that goes out 35 days. This is our flagship RateCast product in greens, predicting what rate view will be 35 days out. Of course, it more heavily weights long-term seasonal trends. It's bounded by an upper and forward-looking error bands in yellow and red. And of course, the blue is the rolling 7-day weighted average of actual loads moved over 550 miles, excluding fuel. So line haul only. Dry van, we've seen the influence of produce seasons through July 4 here. Dry van spot rates up 4 cents a mile to July 11, averaging $1.73 by the time we get there. That'll be about 6 cents a mile higher than where they were last year. The low case has rates flat, high case has rates up 9 cents a mile, but I think Raycast is going to be right on the money there, given my earlier comments about produce season. It leads us to the refrigerated forecast. Spot rates will be up 5 cents a mile. Remember last year they were up about 8 cents a mile over this period. We expect by July 11 they'll be about $2.02 per mile. That'll be about 3 cents a mile higher than where they were last year. Same as dry van, the low case has rates flat, high case has rates up 10 cents a mile. But I think given how much truckload volumes are down out of California, I think Raycast is going to be your best indicator there. And in flatbed rates, they expect to be down 4 cents a mile out to July 11 at 2.15. Last year, they were about 2.02. So this year, we expect them to be about 13 cents a mile higher. Lots of model agreement there. So let's go to the next few slides. There's 3 slides here which are talking about our contract market. Chad's away today, so I'll quickly go through some of the charts here that show us what the replacement rates look like based on recent RFPs. What we're seeing here is that dry van rates are coming in lower based on recent RFPs. Shippers still have pricing power. Rates are down 0.7%. So that means that carriers are reducing their rates to hold volume by about almost 1%. The prior period, they were up slightly. So they've been bouncing around at this plus or minus 1% for quite a while. The year-to-date average replacement rates coming into routing guides for the first time are up 0.8%. The one-year average has rates up 0.6%. The two-year average has rates down 2%. So there's some gradual improvement, but essentially that market is moving sideways. In the temp control market, new replacement rates are coming in at minus 4.1%. They were up slightly. So again, contract rates, this is representing about 80% of the loads moved, are decreasing at a time when they normally increase, I would expect. The year-to-date average is down 0.4% in reefer. One-year average replacement rates are down 1.1%. The two-year average replacement rate for reefer is down 2.4%. Worst story in flatbed. Flatbed rates are coming in at about 4.8% lower, so still excess capacity in the contract flatbed market. The prior period, they were down 2%. As you can see on the chart there, they've been in the red or the negative territory for quite a long period of time. Year to date, flatbed contract rates down 6.4%. One-year average down 5%, two-year average down 4.7%. So essentially, they've been dropping at about 5%. For the last couple of years to hold as carriers try to hold volume. So shippers have definitely got pricing power there. All right, so I think that brings us to our question of the week, and to bring Chris back in. Chris, last year was tough for carriers, as we talked about at your recent conference in Indianapolis. How's this year shaping up?
Unfortunately, not any better, and in some cases worse. There was a little bit of optimism that began the year. You would have seen it obviously in the spot rates increasing. So for those carriers that had a higher percentage exposure to spot freight, they actually had a pretty decent January and into the first week in February. Yep. But among our 71 carriers that we work with currently, there's only 6. I checked that this morning. 6 carriers that are actually have made net profit year to date. The rest are above 100 from an OR perspective. And the range goes from, obviously up 100 all the way up to 122, 123. So it's a very tough environment. David Roush, our president, he a couple of years ago saw, kind of this, long term, since we do have the financial data, we obviously do study economic trends and listen to you, Dean, and others in the market. He didn't see anything tangibly affecting the demand side, and obviously the capacity side hasn't bled out like most hoped. So we don't foresee the rest of the year being any different than what we have right now. So it's really a survival of the fittest, survival of the ones that are willing to take action, cut overhead. Obviously they can't cut tractors, because if they put them out in the market right now, they're not getting anything for them. So it is very challenging environment, and what you were just talking about in terms of the rate trends, we're seeing the same. I think a couple of weeks back we saw some uptick on the spot rates, so some carriers slightly for the week dipped into profitability. Again, those with higher spot exposure, but the majority of our carriers have a 10 to 15% broker spot exposure, so that effect was mitigated for them.
It's kind of like the market's frozen in time. This is sort of one of the most bizarre periods I've seen. I jokingly said to someone, it's actually fairly easy to forecast where the market's going because no one knows. Like the stock answer is we don't know. And I don't think anybody knows where this market's going to go given how unprecedented it is. Because I was at a truck show in Wisconsin last week, and I was talking to a fleet owner, and he has a dedicated contract, and this I think supports what you're seeing, and that is in dedicated in particular a lot of churn. He's had an account for about 20 years, which is to the point where he has keys to unload during the night to unload the refrigerated freight. So it's fairly specialized, strong partnership. 20 years they've been doing this work. They've just been undercut by another carrier substantially to get that work away from them. So this is the market we're in, and that kind of has been borne out by the decreasing rates that we're seeing based on recent RFPs, where carriers are lowering their rates to maintain volume. But at what point do you think, Chris, we get to levels of unsustainability? And I think sort of where I'm going with this is you and I were at Freight Waves back in 2019. If you remember that period, that second quarter of 2019, we saw record levels of bankruptcies. I think this year has some of those ingredients. I don't know that we'll get there. So maybe if there's complete demand destruction, but it kind of feels like we're treading water. And I think you're right. Those that can survive and keep costs down to get through this year. I don't know. I sort of go between pessimism and optimism here. I worry about the worst case scenario coming true, which is what we saw in 2019. What are your thoughts on how this market lands this year?
Yeah, I think the key driver of potentially improvement, again, are the equipment lenders. So they're sitting on debt, a lot of debt that is basically uncollectible. They know it, the market knows it, the carriers know it, and there's a significant amount of the population from a percentage perspective that are essentially walking dead. So regardless of what occurs, whether there's a run up 3 years from now or a year from now, they don't have the funds, nor will they have the funds to repay that debt. So I think what you'll see is one lender, taking the hit, making a massive adjustment on their quarterly earnings, on their balance sheet, so taking that hit, and then you'll see a string of other lenders willing to do the same, get it off their balance sheet. And as a result, obviously you don't want to see people fail, you don't want to see job losses, but in order for this market to get back to a sustainable level where revenue is covering costs and having a small amount of profit, you need a mass exit of carriers large and small. So there's large carriers that are walking dead and micro carriers that are walking dead. It's just the lenders have to take action.
Wow. That's incredibly insightful. I hadn't thought about the magnitude of that, Chris. I was in a truck stop on the way out to Madison. I was listening to a couple of drivers in a truck stop in Joliet, and they were talking about the same thing. I think they might have been in that last category. We're talking about the micro carriers that are really struggling. One of the guys was suggesting that there's a lot of flipping of trucks with contracts, and they were mentioning one of the large digital brokerages, and I couldn't quite grasp what he was talking about, but I think it leads to what you're talking about, which is they were kind of transferring the asset to some other carrier because it was no longer sustainable. I think that's what they were talking about. But this is sort of maybe a Chicago specific deal. But you're right. There's a couple of things that could explain why carriers are hanging in this market. That is one, where the lenders are sort of giving them some runway there. The other is that they made pretty good profits. And I think there's another cohort that did pretty well during the pandemic and can afford to run for fairly low rates. So when you go out and talk to your customers, given sort of, the doom and gloom, what do you talk to them about? Like, where do you sort of start the conversation?
Well, our mantra that underlies everything is is density drives efficiency, efficiency drives velocity, velocity drives profitability. So starting off at the one end of the spectrum, density is stop going to areas where you're simply generating a net cash burn. So we get them to focus on a geographic area where they have consistent freight so they can plan it well, and they're not doing broker to broker to broker movements to keep tractors moving. They're doing hopefully, 2 shipper loads for every 1 broker load. That seems to be, the winning combination, hopefully more so that ratio grows over time. But we have been able to demonstrate that the more density you apply to a certain specific targeted geographic area, the more chance of success you have overall. So what that typically means in this environment is you're going to have to shed capacity, and that means at this point sitting tractors against a fence. So some carriers are on interest-only terms, or they have payment waivers. Some have that debt. Some have fully depreciated equipment. But once you get above 130, 140 ORs on a tractor, you're no longer contributing to overhead. You're actually burning cash on a daily basis. So we're instructing them, if that's occurring, you need to sit them against the fence. So the general rule of thumb is if a tractor is using 60, 70, 80% of the freight that they're hauling is broker, as a rule of thumb, because there's that, that margin in between, that is a good rule of thumb as to whether that tractor needs to be sitting or not. And then the tough part, obviously, other than sitting the tractor and the driver, is you also have to shed overhead, because you have to keep those in equilibrium. And that seems to be the area that most carriers have reticence about doing, because they think, okay, this market's going to change. We want to take leverage of but who knows when that's going to be. So it can be a little bit frustrating, but we have some carriers that are very action oriented, that are taking making those moves, and some that did that, a year ago, and are now in a better position.
Yeah, I would think, given where we sit in the market, where it's been going sideways for a couple of years, that there would be an immediacy when it comes to making decisions. Like, it's almost, if you're trying to make these decisions now, it's almost too late, because I don't see anything on the horizon this year that's going to improve the rate outlook. I think this will be a demand-driven market inflection, not a supply-driven one necessarily. I mean, around the margins, some of the exodus of supply will make a difference, but the bigger picture is that 80% of the freight moves on contract still today. It's more like 78%, I think, in May, but those rates are still dropping. It's not necessarily the drivers that are decreasing the rates, it's the people that negotiate rates that are decreasing the rates. So at some point, this becomes a demand-driven event, because the market economics would tell us that there's still an excess of capacity, both on spot and contract, large, micro carriers, large carriers, because rates are still dropping. That's a pretty easy inference. Bill Cassidy's Journal of Commerce Index that we shared at your conference, they're still trimming fleet counts after about 12 quarters. So large fleets have been dropping their tractor counts for about 3 years, which is extraordinary. But we're down to fleet counts that were around 2014 levels. So it amplifies your point about the situation lenders are in, because I suspect there's a lot of trucks out there looking to be sold. And there's a lot of carriers that have got trucks that maybe are financed that are not worth much at all on the open market. And then, of course, the lenders have got a much bigger level of exposure.
Yeah, it's a very tough environment. And, the one thing I'll say is, truckers are resourceful. They're problem solvers. So they can squeeze something out of almost nothing. And you've seen that happen over the last couple of years. They've been able to do that and still stay afloat. So, kudos to them, but there's also some realities that many carriers have to deal with head on, as opposed to kicking down the road.
Yeah, I don't think you could want to be kicking anything down the road right now. Sitting here in June, you'd have to be making some fairly urgent decisions this week about whether to park trucks or reduce capacity, because there's just, we know that shippers are in this state of paralysis. They don't know on an hourly basis what the market's going to look like. We need a lot more certainty to budget and plan, and it's just not there in the market. Now, in the spot market, Chris, there may be some volatility that helps carriers
Yep.
We know that import volumes from China are kind of going to surge in the next few weeks. That'll help Los Angeles, it'll help Memphis, Kansas City, which are sort of direct lines on the rail. So dray carriers could benefit inland. It could be some volume around Savannah and some of the bigger ports. So I think there's probably pockets where there could be some opportunity, but I wouldn't be thinking that rising tide lifts all boats, to use that analogy, because I think it's going to be very spotty, to use that analogy.
Agreed. And you mentioned the dedicated. We have carriers that have pretty large dedicated operations, and when we segment those are basically sustaining the overall business. But there's, like you've mentioned earlier on the call, those dedicated accounts are under attack, just like the rest of the market. And one of the things that we're seeing, which is alarming, is we're seeing prospect carriers where they've had a 60%, 80% in some cases exposure to one customer, and they thought, just ride this train forever, and historically have been at 90 ORs, and obviously the planning is a lot easier and the drivers love it, but now the competition is just heating up like anything else. So in those situations, it's not just losing an account, you're losing basically your business if you don't follow the train down in terms of the price. So it's definitely tough on that side as well.
I think this year's going to be pretty tough for carriers. I like your thinking about cost control, because that's about the only way you're going to be able to maintain those operating ratios at sustainable levels, is cutting costs where you can. Chris, that kind of brings us up to the end of the show. This is fascinating. I've learned a few things. I wasn't fully appreciating the impact of what lenders could have on the market. That's a great point. What else? I guess there's some people that would want to contact you after this, especially if they're a mid-sized fleet or a small fleet. How can they get in contact with you?
Yeah, so our service, even though the consulting practices, KSM Transport Advisors, our product service is called Freight Math. So freightmath.com. So they can go there and learn more about it. They can sign up for our monthly newsletter called Freight Math News, which is entirely educational. And then also you can reach out to me, Chris Henry. So chenry at ksmta.com.
Great, fantastic. All right. This will be, we'll push this out on social media. We'll get some more traction and publicity for this. This has been a very interesting discussion. A couple of shout outs. ACT Research Market Vital Seminar, August 20. You can go to actresearch.net to sign up for that. I'll be there speaking. I'm also at the TSMA conference in Austin, Texas this week. Chris Kaplis has a new guest out on the Freight Vine podcast. Christian K.O. O'Meara from Jaeger is on the show talking about transportation procurement and non-financial factors that they use in the vendor selection process. Next week's show, long-term friend Damon Grewell from Centurion Trucking in British Columbia. He'll be talking to us about some of the cross-border trends he's been seeing. Make sure you set up alerts for our live show, subscribe to our channel, and with that, another show is in the books. Be safe, be nice to everyone. Thanks for watching. We'll be back here again at 10 a.m. Eastern, 7 a.m. Pacific next week.